a meeting agenda set forward here. I want to apologize to you. Normally we send out our production days in advance. We only sent this production out this morning because we were working on what's a bit non-traditional in terms of our approach today. So let me put my glasses on so that I can see what we're talking about. I want to talk to you about changing the fiduciary process, about formalizing some of the things that probably make sense to do in the context of this retirement plan. What we have here is a fiduciary endeavor. I don't know that you've thought about it. Perhaps you have. Perhaps you're quite well aware and informed. But the parties who are responsible for making decisions, clearly historically that has been the commissioners. In the deeper history, it was only the commissioners, in my experience. Perhaps in more recent times, it's also been the county treasurer's role to participate in decision making. But anybody who participates in decision making is a fiduciary at law. I'm proposing to you at today's meeting that we actually form an investment committee, that we form it by charter or written charter. And using our financial technology partner, who is a very large firm in Southern California that provides information to about $1 trillion worth of retirement plan assets. We've used their ERISA attorneys in their standardized documents to create a proposed investment charter for you. And this is to form a committee. It's, in other words, if you take a look at how I've got this set up and historically have this set up, this says attendees, and Deborah Jacobs and Deborah Garland, and a lot of people are mentioned that probably really aren't fiduciaries. In the future, I would like for this top line to say fiduciary investment committee and have only the names appear of those people that the county has designated as the decision makers for the retirement plan. And you decision makers have been in the past and will be in the future fiduciaries with a very high legal duty in terms of the behavior that we need to exhibit. Now, I think that you clearly passed that test. What I'm trying to do is I think we have somebody in the cafeteria that joined us.
Boy, yes.
I'm not sure what that was about, but it seems to be under control.
So, Madam Chair, would you mind if we, disappeared. I was going to ask that person to,
It looks like they've disappeared, which is what I was looking for.
Back on my screen again.
Could it be maybe just somebody from the community that's joining a public meeting?
Debbie, is this advertised as a public meeting with a login? And I don't see Deb on here anymore either.
Well, because it's not our meeting, David. It's a Zoom link that comes from John's staff. So we don't have Deborah Garland running the meeting because it's not our meeting, it's John's meeting.
Okay.
But I was just curious.
So John, do you make this a public meeting and advertise them calling?
No, actually I do not. And it seems like something that we need to consider for the future, possibly even for the present. What we're doing is recording this meeting, but I have no way to advertise this or make it a public meeting.
We advertise it. So David,
Okay.
it's not our meeting, but we do advertise it. When I read the announcements at our board meeting at the bottom of the agenda, this is one of them that we announce.
Okay.
So, but I believe it's a call-in number, not a video link that gets announced.
Okay.
And
So in terms of who that was that popped in, Martha, somebody.
Yeah.
I saw
no
that
idea.
for a moment. I assume it's somebody from the community at large.
Well, we don't post this meeting.
Oh, you didn't.
It would
You
have been a
didn't post
phone
it.
number if
Okay.
it was from the community at large.
Okay.
So it is an odd moment. Not that this is a private meeting. It was just an odd moment.
Well,
Yeah.
we'll consider this a gift from Zoom and move on.
Okay.
Okay. So So the purpose then is that we have historically always had these meetings recorded. And there are many participants, but I propose to you in the future that we create a specific fiduciary investment committee with named people. Their names would show up simply as members of the fiduciary investment committee. No other names would show up in any recording where we can see an image, or anybody calling in where we can't see an image. We're making clear, for the sake of the record, those people that are responsible for decision-making, literally the fiduciary committee. And if we were to look at the proposed investment committee charter, I've already mocked it up for Tillamook County. I don't expect for you to render judgment or a decision on this today. I mean, you could have a snap judgment where you say no, but I would propose that you take this into consideration, where I purposely have bolded and highlighted in blue certain text in a color so that we can make it pop, so that it's, you don't have to feel like you need to press into all the language for purpose of this meeting. But the Fiduciary Investment Committee is composed of individuals by Tillamook County Board of County Commissioners to serve the pension plan as fiduciaries. The Fiduciary Investment Committee would be delegated. The commissioners would determine who would sit on the committee. People would be invited to it. There is a formal acceptance. It's very short, but there's a formal written acceptance for parties who are accepting appointment, and there is a formal written resignation for parties who are leaving that appointment, whether they're asked to leave by the county commissioners or whether they have quit their job and they're no longer a member of the pension and they're moving on, or whether they simply feel that they no longer want to serve on the committee. I see two logical ways to staff or to appoint people to the committee. At a minimum, it might be the 3 county commissioners plus your treasurer. Could be bigger than that, but at a minimum, it would tend to include that. Or as a second alternative, it could include 1 or 2 county commissioners, not necessarily all the commissioners, and Joel and your county treasurer, and potentially somebody from human resources. But everybody, as is true in the past, everybody who is named to this committee needs to understand that they're a fiduciary held accountable to a high standard. And again, the purpose of this is to clarify more than just through the meetings, where there's a lot of discussion, sometimes by people who are making decisions, sometimes who aren't, where most of our plan sponsors have entered into a committee charter that looks like this. And I'm proposing that you give it similar consideration. What it says is that that the investment committee is to follow the investment policy statement. The latest update to your investment policy statement, I believe, is in 2017. Rewrite your investment policy statement. The investment policy statement would be created. It has been in the past been created, would continue to be created by the Board of County Commissioners. And it designates the responsibilities and the goals for this committee. Because what fiduciary law says is that those who are in charge may delegate to others the duties under the plan. Some of that is delegated to Milliman, some of it is delegated to us as a registered investment advisor, retirement consulting group, some of it is delegated to your custodian principal, some of it is delegated to your attorney. It's completely normal for the vast majority of the duties to be delegated to expert third parties, but this is the normal form for a plan sponsor to designate, here is our committee that is responsible for making decisions to the plan. Let's jump out of this and go take a quick look at.
Jody has her hand up too when you have, I don't know if you can see people while you're presenting, but Jody has.
Oh, I'm so sorry. Jody, please ask your question.
John, I just wanted to give the Board of Commissioners and Joel and Sean kind of some background, where as I'm getting up to speed, some of the things that when we're looking at our plan, you know, this is kind of the playbook where the Board of Commissioners legal, the treasury would follow when it comes to this plan. And it would prevent maybe some large swings in any one way. So it talks about what we're going to invest in, when we're going to be moving, when we would be moving investments away from a certain path. It would also really identify who's in charge of making decisions, if we're going to amend the plan, if we're going to make decisions on certain types of actions. So let's just say we sunset our plan and we're going to modify our plan. This gives a charter and kind of a rulemaking or an authority that's very clear. And this is a best practice in plan administration. This happens, PERS has one of these for their plan. It's giant. It's a public meeting. Everyone goes on a quarterly basis. But on smaller groups where there are 401ks, 457s, they're also ran by this best practice. So I just wanted to make sure you had some sort of perspective of what this plan was. I wasn't aware John was going to present this today, but there's decisions that we could make through these kind of designs, but the concept, and I fully support the concept. We may have some ideas in design, but it is a best practice that I would fully support. Thanks,
Any
John.
No problem. Any questions before I continue a bit more?
So John, I would have one. So the page you were on previously and this page are not included in the
I think
you sent.
I think they are in your version. Can you see where my cursor is at the bottom of the page in the footer?
Yep.
Go ahead and click 1.3. Click here.
No,
Is it there?
here it is. Okay.
Great, super. And the reason for it is that the presentation became so freewheeling, jumping from page 2 to page 7, where we have additional documents, that by using these pop-ups, any place that you see red text that says click here allows another layer to be added. And the way that you make a pop-up disappear, you wouldn't know this otherwise. You see where my cursor's at? Anywhere in the center of the text, click it and it goes away. So you click it once to implement it, and you click anywhere in the text of the pop-up to make it go away.
Right. Tricky.
Tricky, but it's a very handy aid if you happen to be the presenter and you're trying to present something that looks like a linear presentation, when in fact it's not a very linear discussion. So the investment committee charter doesn't normally delineate, there's page 2 to the investment committee charter. It does not normally delineate all of the standards that would be followed by, in my case, the registered investment advisor, but it can be rather expressive in terms of the expectations for duties that the fiduciary investment committee is delegating to other third parties, like the actuary, like the registered investment advisor, like the custodian. And what this amounts to, it's a formalization of process, so that if people come in after the fact and ask the normal, why did you do this question? How did you do this question? By what authority did you do this question? That we have a symphony in terms of it all comes together cleanly, rather than being a date oriented litany of notes and compendium of documents. This simply makes it cleaner. Okay, so there's an acceptance of fiduciary designation. There's a resignation of fiduciary designation. That's very important, because everyone who's ever left this, let's call what we have today the assembly of people, they've they've gone and they've retired. Commissioner Yamamoto one day will retire. And it's important that we formalize that resignation and recognize the fact that he's no longer a fiduciary. And so it's just good process. Any questions before we move on to the next piece? Okay. So continuing on to the next page, I'm also proposing that we've always met on a quarterly basis. I propose that we continue to meet on a quarterly basis. But I also propose something I've proposed over many years in the past, probably not in recent years, that we periodically get together with the other associated professionals, such as Milliman as actuary, principal on occasion as custodian, and your attorney responsible for your plan design occasionally. This is just a proposal, but here's how I would conceive of this. And I've already talked, as I often do, with Milliman. I've already talked with Milliman, and Milliman said, that's a fantastic idea. We really need to do this. And I said, okay, how many times a year would be great for you? And they said a minimum of 2. I said, well, there's 4 meetings a year. So for me, 2 is fine. And then I said, how long would you like? And Milliman said a minimum of 1 hour per meeting, but we can go a lot longer because this is really fascinating stuff. And I hope you agree that this is the best meeting you get to come to every quarter. So what I'm suggesting, and you can do anything that you please, is that, and January was picked for a specific reason, that in January we have all 4 of the principal parties meet. And in fact, I would propose, if it's workable to you, that we all meet in Tillamook, and that the meetings begin at 10 o'clock in the morning, and that will take care of 2 vendors, and that there's a break for lunch, and that after lunch, there's a meeting of the remaining 2 vendors. We would meet with you at the next quarterly interval in a normal way that we always do. At the next quarterly interval, the semi-annual interval, Milliman has asked to be present. We meet at the next quarterly interval, just us. And at least once a year, I think that for a short period that I think is half an hour, I'm not sure it will take an hour, I don't know how it could, to have bring principal forward as custodian and have them present. And then also, I would suggest that we designate at least an hour for Hirschner Hunter, more or less, depending upon year to year, what Hirschner Hunter feels that it needs. And you're going from what has been 4 hours of commitment per year to something like 7.5 hours of commitment per year. But it is a $90 million endeavor, infecting a little short of 500 total members. So it's an important thing. And I think that you'll get far better organization, and we'll be able to keep the plan, which I think is important, and you'll see later in just a moment. We'll also be able to keep the plan more modernized. It's terribly important that the investment advisors stay in relatively close touch with the actuary, because the whole purpose of funding a plan or investing the assets is to match it against the emerging liability, and only the actuary knows the emerging liability. So periodically throughout the year, I will occasionally have telephone calls with Milliman about this or that and ask them to send any reports or compilations that they might have prepared so that we can think about the emerging liability as it's changing. And it changes a lot. You'll see that in a moment, as it's changing, so that we can make sure that the assets are well aligned and likely to perform well against the assumptions that are made by your actuary. Do you have any questions, or is there any desire to say, this is a great idea, why don't we do this? Or contrary to the opposite? What's your reaction to this, commissioners?
Well, I can just speak for me, having only been at this for, 2.5 going on 3 years, that the more information I think would certainly be a helpful format. So from my perspective, I know 3.5 hours is often challenging to get all 3 commissioners to have the same 3.5 hours on the same day. So that is to be seen, but I think that certainly I can say, having done the preparation we've done in relation to bargaining and actually hearing from Milliman has been exceptionally helpful. So I can only imagine that hearing from others would likely be helpful as well.
And of course, it's not necessary that we all meet on the same day, but it's not even necessary to do it all in January. It could be a different time of the year. Although Milliman was pretty specific as we thought about when their work product emerges and when it's ready to discuss. They were pretty specific about the timing during the year that they would really like to meet and talk with you, so that they can be as current as possible with their compilations.
So John, I would just bring one comment to the table here. People have a real disconnect with really what commissioners do. And
Sure.
we are all quite busy. I'm looking at this education module videos for fiduciary education program. 8 different topics, up to 4 or 5 different parts per topic. And I don't know if this is going to be required of anyone appointed to be a fiduciary for Tillamook County, but I would say this, if I'm correct in my thought process here, this could be a real problem for commissioners to spend this amount of time, no matter how important this is, to put hours and hours and hours behind this, as well as our other duties as necessary. This could be of concern.
Let me speak to the education module specific. I think you raise an excellent point. Concerning the education module, each module is 3 to 5 minutes in length. They're designed to be short because the people behind this understand, number one, it's a dry topic, so you can't really sit down very easily unless you're an insider in the industry and consume 20 or 30 minutes or an hour of information at a time. So 3 to 5 minute vignettes. There's probably some value in doing these at the meeting. We're not going to do this today, but in running an education module at every meeting. In 4 years, it sounds like a long time, but in 4 years, we would complete every education module. Fiduciary law is not continually expanding at a linear growth rate. It grows a little as time goes on, but once you consume the total content of 22 modules, again, that would be over about a 4-year period. If we did 1 module per quarter, then I'd make the argument that 3 to 5 minutes probably somehow we can shoehorn that in, even by not expanding the length of time that we're sitting. I'll be more efficient at my meetings to make sure that it takes place. Now, it's not a requirement to do this. It's a helpful suggestion so that you know that good training resources are available that are written by competent employee benefit attorneys that can distill a large volume of information down to just very short learning vignettes that are pretty easy to consume.
I think Jody has her hand up again.
Jody, please.
I do, Commissioner Yamamoto, I understand your concern for time. There are ways we can design this to scale it. So we could probably use the current quarterly meeting schedule and redesign it a little bit to be able to still meet some of the fiduciary education, still look at the investments, still look at the administrative pieces, and kind of look at, I've ran committees like this in a number of organizations, so this is why I'm suggesting a little bit differently than John has recommended here. But usually every year there's some legal updates, and we would bring Jeff Kurtner in to kind of do a presentation about legal updates, status of the plan. Administratively, there'd be some sort of scorecard about where we are on our custodian and benefit processing. So we have 243 retirees. We pay out X amount in pension. There's this issue about rollout where it impacts our investments when you have tons of retirees rolling their money out at the same time. And then, with Matt Larrabee and Brent, we get an actuarial report every year. It is a work of art. We just got one maybe a week or 2 ago, but it talks about what the estimated spend is. And so maybe not having these big blocks of time, but layering this information in over time so our Board of Commissioners has a better understanding of what our plan is, how it compares to PERS, what our responsibility is and what the intent of the plan is I think where John's heading with this. We have some creativity and scheduling flexibility about how we meet these needs. But being able to, there was some, during COVID, there was some plan updates that may or may not have impacted our particular plan design. If PERS changes and we're reflecting in our plan document PERS regulations, have we amended our plan to meet those needs? So that would be the conversations, and having Jeff come at least once a year, whether it be 15 minutes, a half an hour, written report. Again, what is our plan doing administratively? You know, are we meeting our processing time? Are we having, you know, is our custodian meeting the needs of what we need? Maybe our retirees are stuck in a call log and they can't reach people. And again, I cannot stress to you enough how much information is in that actuarial study. So there's lots of ways we can do it. But, you know, as a group, there's a lot more to our plan than just the investments. And I think John's been managing those very well for a long period of time. But I'm looking at that holistic health of the plan and how can we bring everyone along in that process.
Okay. Thank you, Jody.
I've actually reduced the investment element of this meeting to scorecards as well. I think you're going to find it's, if you like it, potentially highly abbreviated. I think that I appreciate your concern. It's something that has to be top of mind to not overwhelm staff, including the commissioners. But I think this will come together from a time perspective fairly efficiently, notwithstanding my suggestion we bundle it together just to get rid of it all in one time. I think you'll like what you see, especially as this meeting unfolds. We're not going to cover any of the training modules today because we have other high elevation topics to discover. I just wanted you to understand that, as you probably have clicked into it, there's 8 different areas that we propose to, over the course of the next several years, to talk to your committee about. And each one of these elements are a 3 to a 5 minute element. So it can be consumed reasonably easily.
So John, this is Mary Faith.
Hi, Mary. Mary Faith, we never heard your voice. I'm so sorry. What
That's
was your
all right.
reaction to all this?
Well, I think more information is always good. And I'm very interested in hearing from Milliman more often. And basically, I like the structure of this. And I think that if we had a long meeting once a year in January, we could schedule it out a year in advance. We should certainly be able to block people's calendars if we do it early enough. What I'm curious about is what has precipitated this proposal? Why are you proposing this change? I'm just curious about that.
Well, I have proposed nothing quite this structured, but I have proposed elements of this in conversations for over the past 20 years. And more recently, I have been working with Jody, listening to her concerns about elements that need to be developed. And it occurred to me that this would be a great opportunity for me to put together a coordinated proposals for your consideration to step up and formalize some of these processes. And on top of that, I think it's super important to meet with Milliman on a fairly regular basis. I know that I really appreciate the time that I get from them. Principal and Hirschner Hunter. Hirschner Hunter is particularly important. Principal is the only one that I'm not sure as the custodian. I think it's important to, I don't know whether it's 15 minutes a year or 30 minutes a year. I just don't see it going much longer than 30 minutes a year to listen to your custodian and your benefit payment processing agent.
Okay, thank you.
Sure.
Here's the secondary part of my question. Are you anticipating more market volatility, and you feel like we need to be more actively involved in the plan in the coming year?
Well, I do, and it's actually, my answer is a 2-part answer. I do anticipate more market volatility, but all of this today has nothing to do with future expectation of market volatility.
Okay, all right. And are you going to talk more about that?
Yeah, I am.
Okay, thank you.
Right. Absolutely. Okay, so we've talked a little bit about fiduciary training. We've consumed that topically at a high level. I want to talk about some selected statistics. This is where I would expect this kind of discussion to emerge if you ever decided to have a meeting with Milliman as actuary and us as the registered investment advisor, where that they were back to back. If you invited me, I would certainly, ideally, participate in the Milliman conversation. I kind of see this coming from Milliman in the future, but since it's also investment related, it can just as easily come from my side. So with that, I have gone to a common database, publicplansdata.org. Here's a little screenshot of when you land on that homepage. It looks just like this. And they're an organization that breaks down information on about 300 state-administered retirement plans, pension plans, and about 5,000 in the local governments. So I found it very helpful. Things I'd want to know if I were a commissioner or a treasurer, part of it deals with the employer's annual required contribution. They have soared over the course of the last 10 or 20 years ago. It's rather than looking at the colorful chart, it's actually easier, I think, to see things in the columns. But state and local plans were only contributing 6.5% to 9% of pay to fund pension benefits. I'll say this 20 short years ago. It really wasn't all that long. And you can see how contributions have scaled up as a percent of payroll. And this is Tillamook. Tillamook's at 35%. I thought that you might potentially, when you read the actuarial evaluation report, the annual report from Milliman, that you might look at this and be appalled and think that somehow this is an aberration for you. But in fact, when we consider all slightly more than 5,000 local government plans across the United States, they're at about 33% of pay. You're at 35% of pay. Your contribution rate is actually right in the wheelhouse of what local plans have been contributing to retirement plans. And there's a reason why state plans at 20% of pay are, that number is very different than what local plans are facing. And that's going to come out in the next just 3 or 4 slides. Any questions about this before we proceed? Then let's move on. The next selected statistic, the number of people that are already in pay status, they're already receiving retirement checks, annuitants, if you want to call them that, although not that many annuities are purchased anymore, but nevertheless, people receiving monthly benefits. You have 490, down here in the footer, you have 498 total members. You have 257, it doesn't say that, but you have 257 employees that are receiving monthly checks. And the number of actives to people who are retired, for you, it's 0.82 actives for every retiree. That's an awkward place to be. Your people are older. If we take a look at state plans, that works out to be about 1.3 active workers for each retiree. If we look at other local plans as a whole, it's about 1 to 1. You've got 20% fewer workers than other local plans and 50% fewer workers than state plans. Why is that? That's be a great question for Milliman. HR may know the exact answer to this, but I think probably what it has to do is that if you're over here in the Valley and you're working in the areas that would come under PERS, there's a lot of younger employees in their 20s and 30s that for a while take a job with the state or with some element that comes underneath PERS, if not directly with the state. And then they move off and they take a job in private industry and they never come back into PERS. PERS has state plans, probably have less sticky employees on the whole than what Tillamook County does. I imagine at Tillamook County, you're in a very select group of premium employers, and that once, I don't know that this is true, but HR would, once employees join you, I imagine that they stay for very long periods of time. But just like Social Security is under an increasing burden, where 56 years ago, there were 14 workers for everyone that was actually retired, and it was rather easy to maintain Social Security benefits. To have a higher ratio of active employees per retiree is an easier thing to fund for. If we take this to the extreme and we say, well, what happens if Tillamook County had no active members and everybody was retired, then the answer is we need a lot of immediate assets and it's all going out the door to pay for benefits. And so this tells me that, and this is expected to steepen or get worse actually for everyone, because the boomers are retiring out. The boomers are, they're like an egg going through the middle of a python. They're a disproportionately large number of people. We don't have an equal number of people in their 70s and their 60s and their 50s comparing each decade to one another. And as they move through, we're going to see a lot more retirees. This tells me a little bit about how I need to manage volatility for the future, because you have a more immediate need for payments out the door. Plans that have very little immediate need, we can afford to take a more volatile position. In fact, state plans do take a fairly notably more volatile position in their investment portfolios than local plans. You'll see that in just a moment. Any questions about this before we move on?
So I'm processing the 0.82 number. Is that also related to just as the county's resources don't keep, our general revenue resources don't keep up with the expenses, and we have fewer employees overall? So you look at the public works as an example of that, where, help me, David, there used to be 50 employees and now there's 25 or something along those lines, right? So the department itself has simply shrunk. So the employment numbers of the county shrink. Does that also play into when we're thinking of that 0.82 number?
It might, depending upon where the shrinkage occurred. If the shrinkage occurred through attrition, then that would mean that you held on to your existing people in that department and you just stopped hiring new people. So that would mean that the average age as each decade goes by is getting older. On the flip side, if for some reason you had a population of older people leave and what you were doing is you were hiring younger, less expensive workers somehow to replace them, then it would be the opposite answer. I doubt that that is occurring. It seems more likely that the group has shrunk through attrition over the course of time, where you're not replacing employees. And so the people that are there, on average, it's boosting the average age of that group.
Right. And it means we have a retiree that we did not bring in an employee behind them as a contributor.
Right, precisely.
Okay.
Right, exactly. And so it's like Social Security. It's now a more expensive proposition where it's easier for Social Security to become underfunded because you don't have as many actives relative to your retirees. Any other questions before I proceed? Let's look at the actuarial funded ratio for state and local plans. Now, this is just for state plans. To see state and local, we need to look at the columns. And so first, let's look at Tillamook. Your actuarial funded ratio is terrific. It's 82%. Now, this is as of, I have to admit, for today's work, since I put it together starting late last week, I wasn't able to find out if Milliman had the latest annual valuation report. So this is for the report that was mailed out in August of last year. It's already August of this year. I've been waiting to get my copy of it and I haven't seen it come through. So this is for the plan year ending 2021, and you're at 82%. Your assets are 82% of your liability. Whereas for local plans as a whole, it's only 74%. And for state plans, it's a rather low 77%. Your actual funded status is better than the majority of both state and local plans. I think that's something for everyone at Tillamook to feel good about.
Once we see this August, we'll know if we get to feel good. That was after that nice big market.
You haven't
crash,
seen.
Now we're at the market crash, so I'll be curious.
I'm not expecting to see that report before you do, but I gather you haven't seen it either. Yeah, I talked with Milliman last week, and they seemed, I think what I remember them saying is that they didn't have it ready yet. So I think you're going to be surprised. I kind of expect the number to be even better, notwithstanding the market decline, and I'll tell you why in just a minute. I thought you would like to see how Tillamook County is invested relative to how the total collections of all state and local plans are invested. Purely coincidentally, your exposure to stocks is absolutely identical to the average plan that's out there. Your fixed income, though, is markedly higher at 37%. your private equity is zero. Now, private equity is not well understood by a lot of folks. There are publicly traded companies called common stocks, and they trade on exchanges like the New York Stock Exchange or the NASDAQ. But then there are all manner of companies that are, some of them are enormous. Cargill, for example, that are very large private companies, and they're owned by families or collections of families, individuals. And there are people on Wall Street. Some of them work for Goldman Sachs, some work for Morgan Stanley, some work for very small firms like Ridgeview Capital out of Utah. And they raise pools of money from wealthy investors, accredited investors, not your everyday investor. And they might raise an $80 or $100 million pool or something even bigger than that. And they go out and buy private companies that aren't publicly listed. Earlier this morning, I had a conversation with a company on the other side of the river in Vancouver, an engineering and manufacturing firm for the pulp and paper industry largely. And the owner's 63 and was talking about having a meeting today with a private equity group who's interested in making a proposal. So private equity is a way for large pools of money to invest in illiquid, it's their very nature, it's not necessarily a bad word, but illiquid companies for fairly long holding periods of time, usually if they're fortunate, 6 to 8 years. If they're not fortunate and a deal goes sideways, they can go a lot longer than 6 to 8 years before they hope to flip the company for a higher price, just like a portfolio manager would for that's trading stocks at Fidelity or at Vanguard. Warren Buffett at Berkshire Hathaway is a private equity investor. Berkshire Hathaway, if you look inside, only a portion of the portfolio is in publicly traded stocks. The balance of the portfolio is in private equity. Berkshire Hathaway is an enormous private equity player, and pensions, among others, state and local government pensions, participate in the private equity side. You have no exposure there. Maybe we should consider that in the future, but I'll talk more about that in a moment because I need to get to another page. Your real estate holdings are higher than what I expected when I put this together. And it's not because your 3 real estate investments that we made 2.5 years ago have grown and they performed so it's not because they performed so well and that they're overtaking the rest of the portfolio. It's that we have other stock managers that have moved into real estate, and so that our collective portfolio of real estate is higher than what I'd like to see. If you're making a note, this is one of the areas that I'm looking into right now to make a determination whether or how I'm going to recommend that we reduce some of this overlap that's caused by other stock managers and their enthusiasm for stocks. We have about a little less than 10% allocated to REIT portfolios. I also want to add that this real estate that you see here for state and local governments, probably most of it is the equivalent of private equity. It's probably not REITs. It's probably direct ownership of commercial, all different kinds of institutional real estate. Again, compared to stocks or bonds or other liquid securities, real estate is illiquid. Public companies that buy real estate invest in the same buildings, but if it's listed on an exchange, it's called an REIT, Real Estate Investment Trust. Whether some are getting exposure through direct ownership or getting direct exposure through publicly traded stocks, we're a little high on the real estate side. Cash is very comparable. Other is frankly very comparable. Commodities, yeah, pension plans, particularly the state plans, probably have a few commodities related funds because inflation has perked up. It's not a significant asset, and you don't even have commodity exposure, at least not very little, maybe perhaps indirectly through some of the bond funds. Hedge funds, it's hard to call it illiquid, but compared to publicly traded securities, another illiquid area. So if we count through here, private equity, direct real estate, and hedge funds, over the course of the last decade or two, state plans in particular less likely local plans, unless they're for very big municipalities, have moved increasingly into smaller areas of the investment universe in order to try to generate performance. Well, why are they doing that? They're trying to generate performance in order to support the fact that they're less well-funded as assets as a percent of liabilities than what you are. And state plans, not the number of actives. Yes, state plans are trying furiously to maintain their low contribution rate because the total cost of running PERS is simply enormous. And so they're choosing to take more investment risk and hope that, because before I finish that sentence, and hope that, there's only two ways that we gain money to pay benefits promised under a pension plan. Either the employer makes a contribution or the employer earns a return on invested assets, and that return pays for future benefits. Everything that the capital markets doesn't deliver is a direct expense by the employer. The largest plans, the state plans, have been, in particular, ratcheting up their exposure to more aggressive areas of the investment spectrum in order to try to manage that cost lower. Now, you can see that emerge on this chart. We're almost finished with these selected comparisons. You can see that over the course of time, the universe of all 5,000 plus state and local plans has decreased their stock market exposure. They've decreased their bond market exposure, a downward sloping curve. The three de minimis categories at the bottom aren't even worth mentioning because they're so small, but generally speaking, they're constant. They're neither increasing nor decreasing. And the three asset classes that are climbing substantially are either private equity, this mustard yellow color, real estate, this green color, or hedge funds. Now, before I go on, I wanted to come back. I think I've missed a couple of things. Let me show you what has been going on in the capital markets. I think I want to use, over the course of time, since 1980, stocks have gone from historical lows, generational lows in terms of their valuation, have gone from generational lows through many, many ups and downs to the point where at three different times over the last 20 years, the S&P 500 has hit very high notes in terms of excessive valuation. The highest being just 2 years ago in December of 2021, when we'd never seen valuations this far above the regression line or the trend line. Stocks have been expensive overall for about 25 years. Now, it hasn't been a plateau. It hasn't been a permanent climb. Here's a 46% decline. Here's a 54% decline. One wondered what this decline was going to be during 2022, and it turned out to be very mild. That decline was only about 24%. So if you think about it, let me bring Tillamook back into perspective. If you think about it, this gradual but very pronounced decrease from 100% funded 20 years ago. Let me show you again. 20 years ago, we were at one of the major market highs, notwithstanding we were there we're there even today, but we were at the absolute acme a year and a half or 2 years ago. So, yeah, beg your pardon. The decline in the funded status of a plan, the very thing that you said we're waiting with bated breath, not exactly your words, Commissioner Scar, but we're waiting for the Milliman valuation report to see what happened to our funded status. And I said something surprising that I'm going to prove to you now. I almost kind of expect to hold this level of around 82%. I wouldn't be totally surprised to see it improve, because if you take a look, we've been in a beautiful stock market ever since plans were fully funded. how did we go through that beautiful stock market? And how did the average state plan, the average major plans, drop to a 72% funded status, and they're still only at 77? How can you do that in such a bull market? Not only was it a bull market for bonds, but let me show you something else. The last 20 years was an extraordinary bull market for bonds. I may have misstated. Not only was it a bull market for stocks over the last 20 years, but let's go back 20 years right here, the year 2000. That's the year 2000 was that major market peak. Okay, so let's take a quick look at bonds. And what we see is that since the year 2000, interest rates have come down very sharply. And what you know from sitting through these committee meetings is that as you push interest rates down, bond prices go up. How low can interest rates go? Well, actually, we don't know. But for a while in the year 2020, as COVID kicked off, and as the Federal Reserve panicked that we had millions of people sitting at their homes, not going to their jobs, meaning not producing all the things that we produce, causing a new type of federal unemployment insurance to appear for a while, idling the workforce, and effectively collapsing or severely restricting the global supply chain. We had interest rates. Take a look at that cartoon call out box. It says 0.64. We had interest rates approaching zero on 10-year United States Treasury rates. In fact, back in that day, there were a number of Ivy League professors in behavioral finance trying to express how unusual it was that rates were this low. And I remember reading that they came up with estimates like this would probably occur only every 4 or 5 millennia, which it's nonsensical, but which is to say it's very rare. At this point in time, when interest rates were pushed very close to zero on 10-year treasuries, bond prices were extraordinarily high leading up to the year 2022. They were extraordinarily high. If you had a fantastic bull market in stocks, and you had an excellent bull market in bonds, then it still begs the question, how did these wise with excellent advisors, how did these state plans become so underfunded, and how have they managed to recover so little? And the answer is found back on the bond chart. If you'll bear with me. Oh dear. The more interest rates fall, it forces your actuary to use lower and lower return assumptions on future assets, causing the present value of the liability of your plan to soar. And notwithstanding the fact you had good stock market returns, and good bond market returns, what you also had was a liability that was climbing faster than what the returns could produce. And it produced for every type of retirement plan a very severe underfunded status. The primary enemy of pension plans and corporations and public entities that sponsor them, the primary entity during this time period that created this underfunded status, it wasn't market volatility and it wasn't returns. It was the Federal Reserve dropping interest rates to near zero about 2 years ago. Now, what's happened since then? And the answer is, well, since 2020, we've seen the greatest increase in interest rates in the shortest period of time in the history of the United States. Rates have gone from 0.7% to the very terminal end of this to 4.26%. Now, that might not seem like a lot, but when you discount the present value of the liability by these higher interest rates today, and under government accounting standards, you're allowed to use rates that are even higher than what I'm showing you here to discount the liability is falling away. So when you get this next valuation report through July of this year, yes, we're going to have some problems with stock and bond market performance, but I'm going to be very interested to see what interest rate the actuary used to discount your liability, and whether or not the dramatic increase in interest rate has actually offset the change in value, partly because changes in performance, major wins or major losses are collared. And I'd have to go back and look at your valuation report. But if you book a very large gain like you did in 2021, or as opposed to a loss in 2022, the totality of either one of those large movements is not expressed in the actuary's calculations. It's, I believe in your plan, it's smoothed over a 5-year period. So I wouldn't be terribly surprised to see, we'll see, but I wouldn't be terribly surprised to see that you're rather happy with your funded status when you get this next report. And the more that interest rates go up, which is a perverse thing to wish for, but the more that interest rates go up, it puts pension plans, well, frankly, interest rates are today, without flipping back and forth from these pages, which I know is difficult on your eye, interest rates today are about where they were in 2008. And all of the plans that you see where we're 80 to 85% funded, these other plans, they're not, even though you are. So I'm encouraged by what I think we'll see coming. We'll wait and see. Any questions about that before we move on to a brand new section and I conclude the meeting? Okay. Borrowing from principals custodial summary. We began the year with 84 million in assets. We currently have 90 million in assets. Year-to-date contributions are just a little bit under 7 million. Benefit payments are about 5.9 million. There are 257 members that are receiving monthly payments. We're not back up to the all-time high. We were a little higher than this in late 2021, but we're moving that direction. If you ever want to refer back to this next page, I picked it up from Principal. It shows the products and services that they deliver to your plan in case you're wondering what they do. Quick mention here, Principal is the largest pension plan provider in the United States. It's just that they serve the corporate market with many of their services. And in the public entity side, they act as a custodian, the keeper of the assets, and they act as a benefit processing agent, but then they're unable to serve the state and local government plan in the same way because each state has different rules and each local government has potentially a different design than the state plan, causing Milliman by far to be the largest vendor of pension services to state and local government plans. You're in the right hands with Milliman. And with regard to custody, the retirement of Jill Workman has left us with a relationship manager that, from relative to my needs, I find less than satisfying. But Principal is a strong custodian and benefit payment processing agent. They're the largest in the United States at that particular job. Here is the summary. This is the plan dashboard. The scorecard, I think, is the term that Jody used. Depending upon how you relate to this, we could summarize all of the investments on a single page. We use a third-party evaluation services that tracks a little short of $1 trillion of other qualified plan money. And they score your funds on a scale of 1 to 10 relative to other funds of the same type that we could have hired. You're scoring 9.3. Out of your 24 funds, 20 of them in terms of performance score either a 9 or a 10. One of them scores adequately as a 7 or an 8. Two of them are either collectively on the watch or elimination candidate list. I've looked at those two funds and I've determined that those two particular funds shouldn't be replaced. And to the extent that you have an appetite, I don't want to run out of time today, to the extent that you have an appetite to talk about those two funds, I can explain why, but we covered those reasons why at our last meeting. However, you do have one other fund that scores well that I would replace, and that is the only action that I see coming out of today's meeting. We've already taken a look at your asset allocation. In that case, it was relative to what other retirement plans are allocated. And the average blended investment management fee runs about 32 basis points. Now, I've got one more page, and then I've come to essentially the end of my prepared remarks. Do we have any questions about this page before I continue? Okay. I beg your pardon. I want to jump to page 21. To the extent that you decide that you have the bandwidth, the time today, and the interest, I have prepared a one-page summary on all of your funds so that you could quickly, in about 30 seconds time per fund, you could quickly flip through them like flashcards and see how they're performing relative to their benchmark index, where the very fine black line is the benchmark index and the very bold black line is the fund itself. And I'm not hearing any complaints. So I'm going to take 20 to 30 seconds, if not less, per fund to do that. And rather than spending time announcing the fund names beginning on page 24, we can see that BlackRock over the course of time has done what I would expect an active managed fund to do, to generally generate performance in excess of its benchmark index cumulatively over time. But I can see in 2021, 22, and half of 2023, their performance has either been at the 54th percentile, right in the middle, at the 51st percentile, and on one occasion they were in the bottom quartile. You can see how the wide performance gap that the fund enjoyed has narrowed appreciably over this 2-year time period. They're on my watch list, even if they're not on the watch list of the previous page. I managed to skip a couple of funds, and I don't know how I did that. We'll start alphabetically correctly on page 21. The Bond Fund of America has done a nice job as an active fund beating its benchmark index. Index funds say that this is not possible. Fairly frequently, it is possible. We pay them an active management fee of 22 basis points instead of something like 8 basis points as an index fund, but net of or after management fees, over the course of time, they slowly delivered excess value above what the benchmark index or the same index fund might have generated. They're a keeper. New Perspective is one of our foreign funds, foreign growth fund, and generally it has done a little bit better than its benchmark index, generally landing in the second quartile. And what you can see here, the top 31% right in the middle at the 50th percentile, top third, top 28, pretty close to the middle at 46, top third. We're paying them a management fee of 42 basis points, dramatically more than an index fund, yet they are fairly consistently after expenses generating performance in excess of the benchmark. And this is what we're looking for. The same for Baird Aggregate Bond. We've already looked at BlackRock. Cohen & Steers, one of our real estate funds, has done a very nice job of exceeding its benchmark performance on an after fee basis. I don't like the fee of Cohen & Steers, 76 basis points, but it's dramatically less expensive than owning direct real estate and the costs that are attendant thereto when you buy and sell and run through transaction costs. I think that Cohen & Steers has demonstrated really excellent value to its shareholders by generally fairly often being in the top quartile in terms of performance among its peer group. Dodge & Cox for an international stock fund has done an extraordinary job over time. No complaints. Fidelity Mid-Cap Index Fund. This is what you should expect from an index fund. It so perfectly hugs its index, you can't even see the index because the fund overlays the top. Good job, Fidelity. And they do that for a grand total of 2 basis points. In Wall Street terms, that's almost free. It's a great way to pick up exposure to this asset class because I was not satisfied when I went to identify active managers that I thought were worth paying. The Fidelity NASDAQ Composite Index Fund has actually done an extraordinary job and generally over the course of time has outperformed its index. We'll leave the why for a later conversation. JP Morgan Large Cap Growth Fund, an active fund that is net of fees, beat its index. JP Morgan US Equity, an active fund that net of fees is somewhat ahead of its index on a consistent basis. Metropolitan West Total Return, they've recently had a problem in the 2022 plan year. Their performance is in the bottom 18% of their peer group. We talked about that at the last quarterly meeting. We're not going to replace the fund at this point in time. Anybody who wants to get down in the weeds, I love discussing this stuff. I've got all afternoon. MFS Global Real Estate is another real estate fund that generally over the course of time has either hugged its index, exceeded its index, but in 2022, with a 27% loss, they had a very bad experience, and it took away part of the historical excess performance that we started to pick up in earlier times. PIMCO Total Return is the only fund that I want to replace, and I'm working on the replacement candidates now, and I'll have to get back to you. The reason why, it's an actively managed fund that's consistently underperformed its benchmark index. And we're paying 49 basis points for that. I've got no room for that. I expect actively managed funds over the course of time to generally do better than their indexes. If they can't, at a minimum, I'll replace PIMCO Total Return, an investment grade bond fund, with an investment grade bond index fund, because I can get that index fund for 0.02, 0.03, 0.04, almost nothing. And I know that the index fund will track the index. But if it turns out that there are active managers that seem to be worth consideration, a higher fee in exchange for higher performance, the hope of higher performance, then we'll look at that as I make a determination what to do on PIMCO Total Return. Vanguard Emerging Market Stocks, thankfully, from your point of view, we're almost to the end of the alphabet, so the meeting is coming to a close soon. It's an index fund, and it lags its index a little bit, but over the course of time, it generally stays very close on top of its index. This is a tough category, emerging markets. I find it consistently a very satisfactory fund where relatively infrequently is it in the bottom quartile or the bottom two quartiles of its peer group. Vanguard Energy is the only other fund that gives me pause. I like Vanguard. I like Vanguard Energy. I like the price. The price for an energy fund is 38 basis points. It's not an index fund. The part that I don't like is that Vanguard Energy decided, about where I have the pointer placed, to begin investing a very material amount of fund in utility stocks. So let me use my pen again. In the energy field, you have the upstream part of energy, which are the drillers and extractors, the Royal Dutch Petroleum, you know them as Shell Oil, all the people that drill deep holes and extract gas and natural gas out of the ground. You have the midstream part of the energy industry. Those are the transportation companies, pipelines, tank farms, and distillers. And then you have the downstream end of the energy business, and those are utilities for distribution. And Vanguard has decided to expand into holding a very substantial amount of utility stocks right down here at the bottom. I know it's very small. It's 36% of the portfolio. And that decision caused Vanguard Energy to materially underperform the index that it should have tracked with. I don't have anything against utilities, but what I really wanted was energy exposure. This is very material styled, not style drift. They did it on purpose. They're not drifting. And it may be because Vanguard, State Street Bank, and BlackRock are the three of the biggest, maybe perhaps the three biggest investment managers in the United States. They're also the biggest in ESG, the environmental, social, and governance movements, and that's not bad. But it appears as if in this case, Vanguard is increasing its utility exposure. And it makes me wonder, why would you do that to an energy fund? Because there are utility funds to go purchase if we wanted to own utilities. Why would you do this to energy funds unless you wanted to be a social activist, as those three managers are, and begin to exert national policy influence as a shareholder to utilities and encourage them to move the needle of their business in ways that follow a lot of what the ESG movement embodies. And I'm not against that, but what I am for is investment managers that don't exhibit style drift and don't delete performance unnecessarily relative to their peer group. They still have a very high opinion from Morningstar, not the highest, which is gold, but silver. And that'll be something that between now and the end of the year, I'll attempt to sort out to determine what action needs to be taken. Do we have any, I guess we're not to the end. Vanguard Equity Income is an active fund, has beat its benchmark index. Vanguard Growth and Income, it's a closet index fund and probably should be liquidated in favor of an index fund because they charge 32 basis points instead of something like 0.0, I would have expected 0.04, 05, 06. If I'm going to get index performance, I kind of want index fund pricing, but nevertheless, they've delivered good results. I wouldn't rule out making a recommendation to replace Vanguard Growth and Income. Vanguard High Dividend Yield is very close in its character to Vanguard Growth and Income, and it has been tracking its index. Its history is so short, it's hard to see what's going on, but it's been hugging its index closely. And as an index fund, you can see its expense ratio is 8 basis points, which is more to my liking. Vanguard Midcap Value Index is one of those rare index funds that actually exceeds the performance of their index on a regular basis. The why of that is for another day. Vanguard Real Estate Index has been doing a fine job being an index fund in the publicly traded real estate or REIT category. Vanguard Total Bond Market Index is such a fine index fund that it perfectly tracks its benchmark index, but it adds no excess performance like many of our bond funds do. Vanguard Value Index is, man, that's done a fantastic job. I don't even know how a value fund manages to add that much over the index over the course of time, but you can see how consistent the performance has been for a very low price of 5 basis points. Western Asset Core Bond was doing terrific, and then at the last quarterly meeting, we had an in-depth look at what was taking place, and the answer is, as interest rates in the calendar year 2022 rose more in a 12-month period than they ever had in history, Western Asset was on the wrong side of that with more longer term bonds than their typical peer. And those long-term bonds depreciated more in value. And potentially now they're starting to come back where we can see performance is starting to move upward, but we certainly haven't, it'll take a number of years for us to recover if that's possible. And see this investment strategy play out. I prefer to hang on to Western Asset as a good core long-term withholding, giving the manager time to work through the interest rate problem that 2022 caused. I hate rushing through these things. I'd love to take another hour or two to really dig in and get our hands dirty, but I don't think that there's appetite for that kind of discussion. I want to end on this particular note, and that I believe is going to take us back to page 11. Are you satisfied as an employer, as a plan sponsor, in reviewing the plan as a whole through something like a scorecard? I do not anticipate that on a regular basis that we will dig into the individual mutual fund profiles unless you say, oh no, that's actually quite fascinating. We should definitely spend time. We should spend more time digging into the mutual fund profiles. Every committee is different. Commissioner Yamamoto, I'm going to single you out first because you spoke soonest about the large burden that the commissioners face and the lack of available time. What instruction would you give so that the next meeting hits the mark, offers enough, but no more?
No, so I don't think going through the individual funds one by one is a good use of our time. This plan dashboard is great, although I would like to compare it to what we're buying and compare it to the base allocation investment types. So you can see our scores here, the percentage of assets, blah, blah, blah. But I am not seeing where, how the results that we're seeing are compared to the actual investment types. I think that could be important.
The results that you're seeing are compared to the action. So you want,
So such as,
unpack that.
such as cash alternatives, how are we doing versus a basic investment type of the same, so international global equity,
Right.
how are we doing compared to the overall market for international global equities? Fixed income the same way, US equities the same way.
So if I can play that back to you.
Yep.
Are you saying, let's take this blue colored
equity.
wedge of the pie that's labeled US equity.
Yep.
Let's calculate the performance on the basis of that and compare it to the same component inside of Tillamook County's portfolio.
Perfect.
Okay, I see what you're asking for. What I have to be able to do, and I think I can get that done, what I have to be able to do is, the only way that I can give you accurate performance information is to consider the day that every contribution dollar is invested and the specific price that it occurred at, every dividend and when it occurred, all of the cash flows inside of all 24 investments have got to be tracked to the day that they actually made the purchase. Those are called dollar weighted performances. And that's how mutual funds calculate their performance, is how we calculate any performance internal to this report. Getting that on your pension plan is easy. It's a snap. Getting that same information on the index is what I'm going to have to look into, because I have to, inside of here, this is going to be made up of many individual indexes, because there's nothing that's US equity. There's small companies, medium companies, large companies, growth stocks, value stocks. It's all over the board. And so that I compare, so that I use a uniform way to calculate Tillamook's performance and use the same calculation method against the indexes, I can automatically download all the minutia on your retirement plan directly out of Principal's custodial database at the snap. It runs that fast. But that doesn't exist from Principal inside their database as it applies to these indexes. But I think I know a way that I might be able to do that for you and get you what you need by the next meeting.
Right. And that's the only way I can see that we can compare our performance versus the market performance of the same style of fund that we're invested in.
Okay.
It
was too granular to see it too quickly on an individual fund basis. You probably would, you didn't say this, you'd probably like to see it on the whole plan against a similar construct, using all the different asset classes together, blended correctly, and then on their individual categorical groupings.
Right.
Okay, I'll see what I can do. I nearly ignored you, Commissioner Bell, earlier in the conversation when I forgot to call in your name for an opinion. If you don't mind, I'll just call your name now and say, tell me what you want out of the next meeting.
I don't mind, and I don't feel ignored. And I concur with Commissioner Yamamoto about what I'd like for the next meeting, and I feel good about the track that we're on, and I appreciated the review that you just did, and I thought it was helpful, so thanks.
Okay, thank you. I only feel bad that we went so fast through it. It's fascinating stuff. And we haven't done it in quite a number of years. It's been a while. So periodically it's good to take a look at all the individual components. Commissioner Scar.
I think the dashboard is a great idea. I think that
Great.
really gets us what we need to know. I think from my perspective, and I think I've shared this before, you are the expert. Your job is to keep us moving forward in the direction we need to go in. And if I have a plan dashboard that tells me that I'm at a 9.3 and that 20 out of my, 23 funds are all doing really well, that's really enough for me. I
Okay.
don't need to see the back end. I don't need to have all that. That's why from my perspective, it's why I pay you. Your job's to know the
Sure.
back end and to make sure that you've trained me well enough to know, for me to know what I'm looking at on the dashboard and when I should have a red flag. So for me, dashboard is perfect.
Great. Sean, I don't see your name, but I'm assuming it's just off to the right. If I scrolled over there, that you're probably on the call. Tell me what you would like to see.
No, I
What
like
worked for you?
seeing the dashboard. Gives you one overview. Um, so yeah.
Okay. And then Jody, why don't you help us wrap up the meeting today and tell me what you would like to see?
John, thank you for bringing this. I think this kind of brings together some of the prior conversations we had about the more holistic plan administration as well as the financial side. I think the dashboard is sufficient. I also like the idea of rolling in some more education. I heard Commissioner Yamamoto about tapering it in with or balancing that with, you know, the availability of our Board of Commissioners. But I do think it's important that we as a county understand the plan, how it works, how we make decisions, and you know what that path looks like. I've seen a few things along the way that just making sure that the commissioners understand how much money is under management and how much we're responsible for is really important to me. So, but I do like the shift in format, but the dashboard should be fine.
Great. So we will be working, well, we'll be working fairly continuously throughout this next quarter to develop the next iteration of what we're evolving into be, and evolving these presentations to be. And I think probably only a few weeks out, we'll be reaching out to you again to get in your ear and get inside of your head and showing you mock-ups of where we're going with next quarterly's meetings, so that we come together in a way that we can keep time compact, yet still get the content that the commissioners want to see. Not too much, but not too little. Do we have any additional? Joel, do you have anything? You want to be the sole voice of reason here?
I like the dashboard too. I think it's a good addition. You know, has some good information. I agree with Commissioner Yamamoto. I mean, I know with my personal plan, one of the first things I always want to see is, okay, how's my individual plan performing compared to the market in the same areas, you know? So I think that's good information to have too. And maybe there's a way to plug that into the dashboard going forward, but
I'm sure there is.
Yeah.
My staff actually suggested we take your plan and migrate the custodial information to another piece of portfolio tracking software. And I said, no, that's the output there is going to be too simple. But actually, I think it's the kind of stuff that you want to see. So over the course of the next couple of weeks, we'll head in that direction and get that started and get it done and get a mock-up in Jody's hand, and anybody else who wants to see an advanced copy, maybe I'll just send it to everybody on the distribution list. Okay. All right, so I appreciate your time. Does anybody have any questions, concerns, problems, complaints, worries, things that have been weighing on you that we need to discuss?
Thank you, John, and well done wrapping it up within 2 minutes of 3:30.